To avoid annual fees, look for loans that don't have them, or find ways to pay off the loan before the annual fee is charged. A lady was in a hurry to buy a new car, so she didn't bother reading the fine print on her loan contract. She just signed it. But when her first bill came, she found out she had to pay $12,000 more than she expected. Why? Because the contract had hidden fees that she didn't know about. Like how the interest rate was higher than what she agreed on, there were extra processing fees, penalties for paying early, and even insurance that she didn't ask for. And since she didn't read the whole thing, she couldn't do anything about it. But next time she needed a loan, she was more careful. When the lender gave her a contract to sign, she read it carefully and found some hidden fees. This time, she knew to look out for them and ask questions about anything she didn't understand. By doing this, she saved herself from a lot of trouble and paid less money in interest. So remember, always read your loan contract before signing it. Even if you think you understand it, take your time to go through all the details. It can save you from big problems later on. Let's talk about what you should check for. So why did this woman have so many problems with her loan? Basically, she didn't do two very important things. First, she didn't read the loan contract, so she didn't know what she was getting into. Second, she didn't pay attention to the details in the contract. Things like interest rates, fees, and collateral can really affect how much you end up paying for your loan. And if you don't know what you're signing up for, you could end up in a bad situation. To avoid this, let's break down what you need to check in a loan contract. 1. Interest rate. This is the price you pay for borrowing money. It's usually shown as a percentage of the loan amount. Now, here's where you need to be careful. Lenders often show the interest rate differently to make it seem lower than it actually is. For example, they might say the annual interest rate is 8%. That sounds pretty low, right? But wait a minute. Is it 8% per month or 8% per year? This is important because if it's 8% per month, that's way higher than 8% per year. So always check what the interest rate is, whether it's per month or per year. In most places, lenders have to show the yearly interest rate, but they can also show the monthly interest rate, which is usually much higher. Let me give you an example. Imagine you borrow $1,000 at 8% interest per year. That means you'll pay $80 in interest each year. But what if the interest rate is 8% per month? Well, you'd pay $80 in interest every month. That's $960 a year, which is much more than the $80 you'd pay with the yearly interest rate. Steers. Here's another thing to watch out for. Sometimes lenders add the interest rate to the principal balance each day. That means your debt grows quickly and you end up paying more money. On the other hand, if the interest is added to the principal balance periodically, like every month or year, it's much easier to manage and you'll pay less overall. So if you see something called daily compounding or daily simple interest in your contract, you might want to think twice about that loan. 2. Fees. There are many types of fees that lenders may charge, and they can make your loan more expensive. It's important to read your contract carefully and not just look at the interest rate. Here are some common loan fees to be aware of. First, origination fees. These are fees lenders charge for giving you the loan. They usually a percentage of the loan amount and can range from 0% to 5% or more. So, if you're getting a $10,000 loan and the origination fee is 3%, you'll have to pay $300 just for getting the loan. Next, prepayment penalties. Some loans charge a fee if you pay them off early. This isn't common with most consumer loans, but it does happen. So be sure to read your contract and see if there's a prepayment penalty. If there is, try to avoid paying it. You can do this by waiting until the end of the loan term to pay off the loan, or by making extra payments without paying off the loan completely. Another one is late payment fees. These are fees lenders charge if you're late with your payments. Most loans have late fees, so it's important to know what they are and how much they are. For example, some lenders charge a fixed fee of around $25 if you're late, while others charge a percentage of the missed payment. Let's say your monthly payment is $200 and you're 5 days late. With a 5% late fee, you would owe an extra $10. That means you'd have to pay $210 instead of the original $200. Next, there's annual fees. These are fees lenders charge every year for having the loan. Many different types of loans can have annual fees, so it's important to know if yours has one. Usually these fees aren't too high, but they can add up over time. To avoid annual fees, look for loans that don't have them, or find ways to pay off the loan before the annual fee is charged. Then we have closing costs. These are fees charged when you finish the loan process and get the money. Closing costs are common with mortgages and other big loans. They usually include things like title insurance, appraisal fees, and taxes. Closing costs can be a few $100s to a few thousand, depending on the loan. So be sure to factor them in when you're comparing loans. And finally, there are other fees too, like document preparation fees, notary fees, and even insurance. Insurance might be required by the lender in case something happens to you and they don't get paid back. So, you want to check all the fees in your contract, look out for hidden fees, and make sure you understand all of them before you sign. Don't be shy about asking questions. If you don't understand something, it's better to be safe than sorry. Number 3. Collateral rules. With secured loans, like mortgages or loans against your savings, the lender takes something valuable from you as collateral. If you don't pay back the loan, the lender can take your collateral. In most cases, this is your house or a piece of property. But what happens if your collateral loses value? Say you put up your house as collateral for a loan. If the value of your house drops, you still have to pay back the loan. If you can't make your payments, the lender might take your house and sell it to get their money back. This rule applies to many different types of loans, so it's essential to know what could happen if you can't repay the loan, and know for repayment schedule. Your loan repayment schedule shows how much you owe and when you have to pay it back. D. It usually includes the loan amount, interest rate, monthly payment, and payment date. It's important to review your repayment schedule carefully and make sure you understand it before you sign the contract. If something doesn't make sense, ask your lender to explain it. It's a good idea to compare repayment schedules from different lenders so you can see how much you'll pay over time. This will help you decide which loan works best for your budget. Also, be sure to check if there are any prepayment penalties. If you plan to pay off the loan early, it's crucial to understand the terms of your repayment schedule and any associated fees. So in the end, protect yourself. Read your loan contract before signing it. Even if you think you understand everything, take your time to go through all the details. Ask questions about anything you don't understand. By doing this, you can avoid big problems later on. Remember, the small print can save you a lot of money. Don't just sign on the dotted line without knowing what you're getting into. So now I want to ask you, do you read contracts fully before signing them? Be honest. Also, let me know in the comments if you've ever had problems with a loan contract. We can learn from each other's experiences. Thanks for watching, and see you in the next video.